As mentioned, I've been a broker for several years, and so what I did when I put this book together was basically try to answer all of the questions that everybody's ever asked me over the years, and trust me, there's a lot that goes into that. So, you know, if you've been trading for years and years, obviously a beginning book may not necessarily be something that's high on your list, but I am pretty confident that you'd find something in there that would help you, because there's a lot of information that really isn't published anywhere else. Maybe you know, people might not have thought of certain angles, but because I'm on this side of the business, I can see things that other people can't. And also maybe other people that are in my shoes maybe don't want clients or traders to know some of the things that I wrote in the book. So you might be interested. Kind of already went through this, so we'll skip the overview page. Right, first, I don't want to bore you, but I want to make sure that everybody here knows what we're talking about. So we're going to first cover some basics of currency futures and relate them to the Forex markets. Now, a lot of beginning traders come to me and they want to trade currencies, but they really just don't understand that there's actually two entirely different markets to trade currencies. You can trade them on the futures market, which is the CME or the Chicago Mercantile Exchange, or you can trade them in Forex, which is the cash market exchange. Actually, I take that back. It's not an exchange. It's the cash market, and it's actually, the Forex market is really it's not a single market. It's like hundreds of mini markets that for some reason, someone decided to refer to them all as one market, and so we do. It's kind of like saying, if you say the stock market, you're usually talking about the U.S. stock market. You're not talking about the global stock market. But when people talk about Forex, they're talking about the global Forex market. And like I said, it's hundreds of little markets acting independently of each other. Although the prices all kind of follow each other, they're all tied, but it's not a centralized place where everybody's trading on the same network. It's a bunch of different networks. So anyway, currency futures. A currency futures contract is an agreement to make or take the delivery of the underlying asset at a specified date in the future. Now, most of you probably know this. So, for example, if you buy a euro contract today at about 132.5, or whatever the exact price is, you're agreeing to take delivery of the underlying currency at some point in the future, whenever that particular contract expires, at that price. This is the exact same concept in Forex, but the difference is the time horizon. Forex is a cash market, like I mentioned before. Forex contracts represent delivery in 2 days, whereas currency futures are quarterly delivery, and it's a set date. It's not a rolling calendar like it is in Forex. Currency traders are agreeing to the contract details, like I said, to buy at a specified price at a particular date at some point in March, June, September, or December. Unlike Forex, currency futures are highly regulated, and they have been for a very long time. And this is a big key. I want to give you a quick disclaimer here. We are capable of offering both futures and Forex to our clients. However, you'll notice as we go through this class, I don't want to say highly biased, but that's probably the best explanation. I'm pretty biased towards futures, and I'm going to tell you a few reasons why. I'm not saying that nobody should ever trade Forex. That's absolutely not what I'm saying, because there's definitely some instances where the Forex market has a little more to offer than futures. But if you look at the big picture, in most scenarios, traders are typically better off trading currency futures, and I'll point out a few reasons why. Currency futures are traded on the CME group, as we mentioned before. The great thing and the important thing about this is the CME guarantees every transaction. If you buy a futures contract and somebody else sells it, it doesn't matter if the person that you sold it to can't live up to his end of the bargain. Let's say that his account goes negative, he loses more than he has on deposit, and he can't pay he can't pay the exchange to make up for the losses that he just sustained. To you, it doesn't matter. The CME guaranteed your side of the contract. So if you speculate correctly, it's real money. You made it. You're guaranteed that profit. And that sounds like a given, right? But in Forex, it's not necessarily a given. In Forex, you face counterparty risk. Now, the odds of your counterparty defaulting, usually the counterparty is your brokerage firm, or it might be a third-party bank or institution. The chances of them defaulting aren't big, granted, but you must know that it can happen. And in my view, it's almost like, you know, why take the risk? If you know it's guaranteed in the futures market, why would you take the risk in the Forex market? In the currency futures markets, brokers never become part of the transaction. All the broker does is provide access to the market. They give you the platform, or they execute your trade, or however, whatever type of service level you're on. They give you access to the markets, but they're not trading against you. They want you to make money. They don't, you know, they don't necessarily want you to lose money, because they don't benefit from that. The futures market is much more transparent, and the reason I say that, it's true. If you're a Forex trader, you can pull up any platform and you can see bids and asks and all those types of things. But like I mentioned, you're trading one particular piece of a network. You're trading on one little tiny market, and there's hundreds of other markets out there. In currency futures, it's one single conglomerate market. Everybody that's trading currency futures on the CME, it's all going to the same place. The bids and asks are all going to the same place, and everybody can see them. And also, what I was referring to is transparency in price, but sorry, it's more transparent in terms of transaction costs. We all know in Forex, you know, they made a big, well, they built an industry on the idea that it's commission-free. We'll talk about this a little later. Obviously, we know nothing in life is free. But in currency futures, people feel like they're paying more, even though they're not necessarily paying more. They just feel like they are, because they can see it. They look at their statement and they can actually see the transaction costs come out on their statement, whereas a Forex trader doesn't see anything, so they just assume they're not paying anything, which isn't necessarily the case.
Andreas has a question about volume. What is the daily volume of the Euro USD futures versus the cash market?
Okay, well, we'll talk about a little bit about that in a future slide, but I won't get into that specifics. But what I can tell you is there really is no way to know what the actual volume is in the cash market Forex, because it's not in one centralized location or one particular network. It's on hundreds of networks. So there's really no way to know what the cash market volume is. The CME does publish their volume figures each and every day. I mean, I'm looking today. It looks like on most days the Euro futures trade about 200,000 contracts. Each contract represents 100,000 worth of the current currency. And a lot of Forex traders look at that and they think, well, that's not very liquid. It's, you know, that's nothing compared to Forex. And that's true, but like I mentioned before, if you're talking about Forex as in the global marketplace, that liquidity doesn't really exist for a trader, because if you're buying or selling on the Forex market, you're buying or selling in a little niche of that marketplace. You're not benefiting from the massive liquidity of the conglomerate.
Yeah, you're dealing with just your one bank, right?
Exactly. It might be one bank. Some, you know, if you're depending on the firm you're with, sometimes you're trading against 4 or 5, maybe even 15 banks. But it's not, you know, it's a little misleading. It's not the trillions and trillions of dollars that people think of. It's really not that. And if you're trading with a small Forex brokerage firm, it is very possible that you're trading against your broker, and you really, you know, there might only be 5 or 10 clients trading at that time. So you possibly might be trading in a very, very small and thin market.
Right.
You just don't know it.
David is asking, for day traders, what's the difference between the markets? For example, if he's closing out every day, what does it matter if a market is, you know, 2 days or 3 months delivery?
That's a good question. Honestly, it doesn't. If you're closing out your position every day and just day trading, now if you've traded Forex enough, you know that there's rollovers and all those kinds of things, and interest costs going back and forth, but you eliminate all those types of things when you're day trading. The one thing I can say about that is the delivery doesn't matter to you. You're absolutely right. But what might matter is the margin. and we'll talk about this a little later, but I just want to make sure I answer it now. In Forex, the day traders really don't get a margin break. The margin is it's actually a formula, and it fluctuates, but it's we'll just say hypothetically it's $4,000 for a certain currency pair. It's always going to be $4,000, whether or not you're in and out in 2 seconds or you're in and out in 2 weeks. It doesn't matter. Currency futures have a little bit different environment for day trading. Day trading margins can be as low as $500-600 on some of the currencies. Now, I'm not by any means encouraging anybody to use that kind of leverage. I'm just saying that it's available to currency traders where it's not available to Forex traders. So it's one thing to keep in mind, and we'll get into a little more detail on that in a future slide.
All right, one more question to get us caught up, and then I'll let you keep going. Raymond is asking, and I'm not exactly sure what he's asking, so I'm going to do my best here. I think he wants an example of the euro dollar and Canadian to Japanese yen on how the standard lot on the futures compares to the Forex side. I think he's talking about, like, my best guess is he's talking about the full-size futures versus the mini and micro.
Okay.
And what it is, like dollar per tick and pip.
Okay, those are all great questions, and actually we do cover those in future slides.
Okay,
so
perfect.
Just for the sake of not being repetitive, I don't want to get into too much detail.
Sure.
But we will talk about how, like I said, there are some advantages to Forex, and one of the advantages is it's a little more flexible in terms of contract size. But the futures industry, or the CME specifically, is kind of counteracted with offering new products and things. So we're going to talk about all that kind of stuff and hopefully clarify that for you. All right, one of the biggest advantages, at least in my mind, of trading currency futures, well, I shouldn't say it's the biggest advantage, but it simplifies things the most, I should say, is the fact that everything is traded in American terms. Like if you look at Forex, it gets a little bit complicated because everything is kind of standardized, but some currencies are quoted in US dollars, some are quoted in the foreign currency. For example, in Forex, if you're trading the yen, you're trading the dollar yen, which means the currency pair itself is actually priced in yen, not dollars. So when you trade it, you have to determine, how many pips you made or lost, and then you have to convert it to dollars to figure out what that really means. Well, in currency futures, everything's paired against the dollar. So everything is priced as it would be, like I said, in American terms, as if we're buying or selling another currency in dollars. So, for instance, if the Canadian dollar futures contracts at 95.16, it costs 95.16 cents to purchase 1 Canadian dollar. So for me, it's just a lot easier to get my mind around the value of another currency in dollar terms, as opposed to, trying to trade something in, like, for example, if you were trading the Canadian dollar versus the dollar in the Forex market as opposed to the futures market, it's the inverse. So you're actually trading an instrument that's priced in Canadian dollars, so your profit and loss is in Canadian dollars, and then you have to go and convert that back to US dollars to figure out how much you made or lost. So the futures market just simplifies things tremendously by pairing everything against the dollar, and takes a lot of the calculation and the guesswork out of it. Makes my life a little bit easier. This is going to kind of answer the question that we just received a few minutes ago. In the futures market, there's standard contract sizes. Also, the tick values in the margin they're all standard size. They don't fluctuate. In Forex, the margin fluctuates with, if the euro gets a little more expensive, the margin goes up, and vice versa. The tick value fluctuates for anything in the Forex market that's not quoted in dollars. So like I mentioned before, the yen is actually, you're trading the dollar-yen pair, which is valued in yen. So a currency pair like that in the Forex market, the tick value changes as the exchange rate changes. So there's not a lot of easy math there. In futures, it's always going to be the same. The tick value is always the same, and so is the contract size. So in futures, the standard contract size unfortunately, I wish they would have just made all of the contract sizes 100,000. It would have made life a little easier. But some of them are 125,000. Some of them are 100,000. In the case of the British pound, which is kind of a strange one, it's even a little bit different. But we'll get to that in a minute. In the Forex markets, if you pull up a Forex platform, you actually have the choice. Well, it depends on the firm you're with. I mean, I know all of them are a little bit different, but you could trade 10,000 contracts, 20,000 contracts, 30,000. You could trade 120. You could pick, any random number, usually within a 10,000 increment on your contract size. In futures, it's not quite that simple. If you want to trade a full-size contract, you're automatically trading at least 100,000. You could also add a mini, which is half the size of that, or a micro, which is a tenth of the size of the full size. So in theory, you really could also customize your futures trading just like you could your Forex trading, but it's not as nearly as convenient. In Forex, you use the same symbol. You just type in 130 instead of 100, and you're good to go. If you wanted to do 100,000 or 130 units in the Forex market, you'd have to do one standard size, which has one symbol, which is 6E, and then you'd have to do 3 micros. So, I mean, it's not as convenient, but it is possible. And the tick values, like I said, are always going to be the same because everything's always in dollar terms. No matter what happens to the euro, it's always going to be $12.50 per tick in the futures market. The Canadian dollar is always going to be $10 per tick, and the yen's always going to be $12.50. And we'll, in this slide, we go into just a little more detail. You'll notice that the British pound is kind of an outlier. It's 62,500 units, half the size of the euro, the yen, and the Swiss franc. I'm not sure why they do this. Just a quick warning, a lot of people assume because it's half the size, that means they can trade twice as many contracts, or maybe they think it's a little tamer, maybe it moves half as fast as the others, and that's not necessarily true. I've seen the British pound move, a couple hundred points in a single trading session, so it can really move. So don't let that smaller contract size fool you into thinking it's safer or anything like that, because it's not necessarily safer. One currency that I'm a big fan of that you will not see in Forex is the dollar index. The dollar index is actually, well, it's an index of all of the currencies versus the dollar. About 60% of the index is the euro, because if you think about it, it makes sense. Before the euro, there was, several other smaller currencies, and once the euro was created, then they basically just engulfed 60% of the index. But when you buy or sell the dollar index, you're buying or selling the dollar against about 60% euro, and I think it's about maybe 10% yen, and so on and so forth. So you basically are trading the currency as a whole instead of against one particular currency. And like I said, you won't find anything like that in the Forex market. In Forex, it's very specific. You're trading one currency versus another, and there's nothing in between. So again, if you're trading a standard size futures contract, you're looking at 100,000 units for the Canadian dollar and the Aussie dollar. If you're trading the euro, yen, or the Swiss franc, it's 125,000 units. And I know this, it'll take a little, if you're a Forex trader, this takes a little getting used to. But keep in mind, the mini contracts are half of the full size. So if you're trading a mini euro, it's going to be 62.50. If you're trading an E-micro, which I'm a big fan of the E-micros, and I know a lot of people are probably thinking to themselves that that's just incredibly boring, but I'm going to kind of point something out to you that maybe you haven't thought of before, and so we're going to talk about that in a few slides down the road here. But the E-micros are 1/10 the size, so if you're trading an E-micro euro, you're trading 12,500 units.
Our Bach has a question that goes to the centralization aspect of the futures market. Okay. He's asking, are retailers, or I think he's talking about individual self-directed retail traders, are they directly related or routed to the CME data center in Aurora? Is there any smart route with HFT benefits? So I guess he's asking, first of all, maybe you should explain that any futures broker, it's all going to the same market, So does it matter as far
Exactly.
as, yeah,
It's true. Like, if you're trading currency futures on the CME, so let's just take the euro for example with the symbol 6E. As long as you're trading that contract, no matter which brokerage firm you're using or which platform, it's all going to go to the same place. It's all going to be treated the same once it gets there as far as order queues and all that kind of stuff. You will find that a lot of platforms or brokerage firms, they will talk about low latency trading, and that maybe they're closer, their trade server's a little closer to the CME server in Illinois, and so that'll shave a tenth of a second off. I would say for most retail traders, it really doesn't matter whatsoever. I mean, if you're talking about a tenth of a second in transaction time or less, maybe even, I mean, maybe the difference is a hundredth of a second. In my opinion, this is just my opinion, 99.9% of retail traders wouldn't know the difference anyway. The biggest delay they're going to have in their trading platform or brokerage firm is going to be how fast they can press the button on the mouse, not how fast the data actually gets there. Now it's different if you're a lot smarter than I am, and you're working with, you know how to program systems and you're high frequency trading, maybe that's a whole different story. But for the average retail trader, honestly, I don't think the brokerage or platform is going to matter. It all goes to the same place, and it's executed immediately. So,
right.
I mean, unless the one exception I could actually throw in there is if which isn't dependent on your brokerage firm or your platform or anything like that. But if you have a slow internet connection, that can make a big difference. If we're talking a split second, I think it's inconsequential. If we're talking 3 or 4 seconds because you're on, Wi-Fi in the middle of the mountain, that can make a big difference. The market can move 3, 4, 5 ticks, and that's $50, and
Right.
so that's something to. So in other words, be more aware of your environment and what you've done on your end to set everything up, as opposed to looking for a broker that's advertising the fastest connection speed, because I don't think that's going to matter in your results.
Yeah, I
That's
mean,
my
if
opinion.
if you're an algo trader, then
Yeah,
co-locate in Aurora, but if you're a discretionary
right.
trader, latency probably isn't going to make a difference. Richard
I don't think
is
so. Yeah.
Richard is asking, what's the unit size for the U.S. dollar index?
Okay, that's a great question, and I wish I actually have done in the past webinars for ICE, which is the exchange that lists the dollar index. We've done an entire webinar on the dollar index, so I wish I had a little more time. I could go into all the great things that contract has to offer. Because it's an index, it doesn't necessarily have a contract size. It's kind of like the S&P. There's no size, but there's a value. So, for example, right now the dollar is trading at 81. We'll just make it simplify it. It's trading at 81. Each full point in the dollar is worth $1,000. So the value of that contract right now is 81,000. So if you buy or sell the dollar index, you're essentially trading about 80,000 worth of the underlying asset. Obviously, it's an index, so if the dollar goes from 81 to 82, the contract value is now 82,000, and so on and so forth. But it's really something, if you've never traded the dollar index, you should really look into it. It's fabulous. The margin's low. It's about, it fluctuates, but it's approximately about $1,000 for margin. It doesn't move nearly as quickly as some of the other currencies, so it's a little tamer, especially for beginning traders or people like me that are just, maybe we're just wimps, I don't know. But for personality-wise, those that aren't necessarily big risk takers, it's a better way to trade the currency market. And maybe also it doesn't move as fast because it's diversified. It's kind of like trading, it's like the ETF of the currency market. It's diversified a little bit. You'll see times where, the euro's up big or the yen, but the yen's down big. It doesn't always happen that way. Usually the currencies versus the dollar move in the same direction, but it's certainly possible for them to move opposite directions in a short-term basis. And the dollar index kind of evens all of that out and smooths things out. And like I said, it's diversity.
Last question on the screen. TZ is asking about trading CFDs, contract for difference, and I don't know if it's worth mentioning or not. For all of us in the United States, that's not even legal. So again, that's kind of
Right.
like the spot Forex world, right? There's no equivalent in the futures market.
Right. To be honest, I mean, because it's not something we do here. I'm definitely not an expert on the topic by any means. I would just throw out there, though, that any market that's not regulated and I'm not saying that the governments always have the answer, but at least at least if you're talking about a market that has rules and you're trading against other participants instead of your broker, which that's my understanding is most CFDs you're basically trading against your broker. I'm not a big fan of that because as a broker, I mean I can imagine there's I'm not saying that those types of environments always have negative implications, but the temptation's there. If you're a brokerage firm, you hear about it in Forex all the time. I'm not saying it happens, but it's certainly a possibility of, the broker spiking prices a little bit to run stops and things like that. So as a trader, even though maybe those things don't happen, maybe those are just people speculating on that, do you really want to, in the back of your mind, be thinking that every time you get stopped out? I don't. So.
Yeah, well, I mean, I'll just add a very small bit of perspective from my point of view. I mean, there's a lot of futures brokers, but by comparison, the number of spot Forex quote brokers is just astronomical. And I get so many requests, and they have all these affiliate programs, like they would pay me $500 every single time somebody opens an account. That, which by the way, I never have anything to do with that, but that gives you just a little bit of an insight as to how fair or unfair it might be on some of those. So you really have to be careful and do your due diligence for sure.
That's a great point. And one thing that I don't really talk about just for the currency futures versus Forex debate could really be quite substantial. In fact, like I wrote a whole book on it. So what we're talking about today is kind of minor. But one thing to point out is a lot of the Forex brokers will pay you a rebate. And, it sounds great, right? If you get paid every time you trade, it's actually let me just put it this way. The Forex markets, they boomed in the last 10 years, and they've boomed for one reason and one reason only, because of marketing. They're genius marketers. They came up with commission-free trading. They came up with rebates. They came up with funding your account with credit cards. So all of these things that lure people into the markets that maybe wouldn't have gone before, it's been great for their bottom line. Is it great for speculators? The debate is still open. My opinion, you really have to be careful who you're doing business with. If somebody's offering you a rebate to trade, that means they're probably charging you too much in the first place. And it's genius on their part, because they're paying you to trade, which means instead of trading 10,000 units, maybe you're going to trade 100,000 units because you feel like you're getting paid to trade. You'll probably be losing money in the markets, but in your mind, you're getting paid to trade. So, it's genius marketing. That's really
especially if you're doing business with,
probably not in your best interest.
Yeah, especially if you're doing business with one of the guys that's literally taking the other side of your trade.
Right.
So,
right.
Carly, I don't know if you have a slide that talks about the spreads or not, but you just mentioned commission-free trading. So do you want to talk about how that, it's not really free, it's just a different spread, and how it relates in futures. Do you have a slide for that?
Right. We do touch on that briefly down the road, but it's definitely worth mentioning to make sure everybody understands it. Commission-free trade, what happens when you let's say that you buy the euro dollar in a Forex account. Your Forex broker immediately, he sells it to you, he takes the other side, and then he immediately goes into a bigger network of banks where the spreads are tighter, and then he does the opposite. So he sold it to you, so he goes and buys it in the real market. I say real because it's a bigger, more liquid marketplace, but I don't know if that's the right word. But anyway, so he's offsetting his risk, so he doesn't have trade risk, but he makes money because you're paying, whatever, just hypothetically, you're paying a 3-pip spread to get in and out, but he's only paying 1 pip in the quote-unquote real market. So that's how your broker's making money, is basically charging you a little extra than what the true market price is. So you are paying it, you just can't see it and you don't feel it. And again, it's just fabulous marketing. They did a great job at marketing the product, and that's really the bottom line.
And by comparison on the CME, the spread is always the same. For many, it doesn't matter. Every broker is going to have identical spread.
Yep. Exactly. Yep. Exactly. The CME is centralized, whether you're Warren Buffett or you're some guy, you know, trading in your pajamas at home, the spread is one tick. So, you know, I tend to think it's a much more level playing field. And again, like I mentioned before, I think it's a lot more transparent because you can see everybody's orders, not just your brokers. Like if you're trading Forex against your broker, and there's different environments in Forex. You might, you know, so I'm not saying that all brokers are like that. But if you're trading against your broker, you are basically, he shows you the quotes, right? He's telling you where the market is, what the bid is, what the ask is, so you have nothing else to go on except what he's showing you. And there are some rules in place so that, you know, everything is on the up and up. But like I said before, you don't want in the back of your mind to be thinking, hey, did my broker just hose me on that when I was stopped out and then the market turned around? In the CME, I'm not saying you're never going to get stopped out at the low or the high, but at least you know it's real market action. That is what it is. It wasn't, you know, someone on the other end maybe doing, you know, hanky-panky. So